Welcome to WCS Money Tutorials. Today's topic is the 2021 Child and Dependent Care Credit. This credit could be worth up to $8,000, and under certain circumstances, the qualified expenses that determine the credit can be paid to family members. I want to point out that the Child and Dependent Care Credit is not the child tax credit. It is an additional credit to help working parents pay for child care. However, most people eligible for the Child and Dependent Care Credit will also be able to claim the child tax credit. The major changes to the Child and Dependent Care Credit that apply only to the 2021 tax year include an increase in the credit percentage from 35% to 50%, which increases the maximum credit to $4,000 for one qualifying dependent and $8,000 for two or more dependents. Taxpayers with incomes of up to $125,000 qualify for the maximum 50% rate. But the biggest change for this year only is that the credit is fully refundable, which means many lower income taxpayers will benefit from this credit, where under the previous law they got little or no benefit because they had little or no tax liability. There are also temporary rules for flexible spending arrangements. Unused amounts from 2020 can be added to the maximum amount of dependent care benefits allowable for 2021. Unused amounts may also be used in subsequent years if your employer's plan allows it. You may also receive credit for 2020 expenses if they were paid in 2021. For tax years after 2021, this credit will revert to previous law, making it less generous, non-refundable, but without an income limit. Because the credit becomes non-refundable, it will be limited by your tax liability, which means lower income people will not be able to take the full credit, if they even qualify for it at all. For instance, most people with children will be able to claim as head of household or married filing jointly. So if their AGI was less than $17,000, they would not be able to claim this credit, even though they would qualify for the highest credit percentage because their standard deduction would be greater than their AGI, which means they would have no tax liability just based on their standard deduction. Furthermore, the AGI on which the credit percentage is based is not adjusted for inflation, which means that more lower income Americans will not benefit from this credit at all. Precisely the Americans who need this credit the most. To claim this credit, you must fill out Form 2441, Child and Dependent Care Expenses. Although most people will file electronically, this form will show you precisely what information you need and other special requirements. This credit is calculated simply by multiplying the credit base, which are your qualifying expenses of up to a maximum of $8,000 for one dependent or $16,000 for two or more dependents, by the credit percentage, which is 50% for incomes up to $125,000. However, as I will explain later, this credit may be further limited by your earned income. This is the 2021 phase-out schedule, showing the credit percentages for incomes up to $125,000, which is just 50%, then phasing down 1% for each $2,000 of income over $125,000, up to $438,000, where the credit phases out completely. This credit was designed to allow people with dependents to work, so naturally, this credit has the following requirements. You and your spouse, unless it's disabled or a full-time student, had earned income earned from work or self-employment during the year. You paid the expenses so you could work or look for work. Your credit is limited by the earnings from work. If you are married, then the credit is limited by the earned income of the lowest earning spouse. So if you have qualifying expenses of $16,000, but the earned income of the lower earning spouse is $10,000, then the credit base is $10,000, which yields a credit of $5,000, assuming you qualify for the 50% credit percentage rate. The main thing to note here about filing status is that if you are married, then you must file jointly. However, you can be considered unmarried if you filed a separate return. Your spouse did not live in your home for the last 6 months of the year. You provided the home for the qualifying person for more than half the year and paid more than half the cost of keeping up the home. The main requirement for a person to be qualified for child care expenses for this credit is that they be younger than age 13 when the care was provided. However, there is no age limit for a spouse or dependent who is physically or mentally unable to care for themselves. As I explained at the start of this video, you may make payments to relatives, but to qualify for the credit, they cannot be anyone that you or your spouse could claim as a dependent, or any of your children younger than age 19 by the end of the year, or to someone who was your spouse at any time during the tax year. Moreover, care expenses that were reimbursed, deducted, or excluded do not qualify for this credit. Naturally, to qualify for this credit, you must provide information about the provider, including name, address, and their taxpayer identification number, which is usually their Social Security number. If they refuse to give you this information, then report what you can on Form 2441, then attach a statement with your name and Social Security number explaining that your request for the information was refused. The easiest way to get this information is to have your provider fill out Form W-10, which you should keep for your records. Although I have covered most of the main points about the Child and Dependent Care Credit, there are many details that I could not cover in this short video. You can find additional information in IRS Publication 503, Child and Dependent Care Expenses, and in the Instructions for Form 2441. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials on personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.